Hi there, Phil Rogers, Lauren Hall here from Loan Market Edge, coming to you with our weekly wrap. All that is trending in lending. So, no surprise to anyone, but we'll be recapping a couple of things over the next few weeks. The run home to Christmas, crazy. We are, was it 30 business days, yeah? Or 60 odd days in general. Like that is, we are on the home stretch. And I guess context to that in that lead up, as we talk about a lot, is how long do we have left? If we wanted to sign a contract, buy a home and be in to the new home before Christmas, which is an exciting thought, might not work with all banks, yeah? We're going to run out of time really quickly. So if you're conscious and that's your plan and that's your timeline going forward, understanding if you're sort of signing a contract, you're going to have a finance date and a settlement date, really you've got the next 1 to 2 weeks to be comfortable in that. We're starting to see the emails come out from the banks now giving us dates around when it must be unconditional by to be able to settle by these dates. They are being proactive, I think, which is a really good thing this year. I think you're probably a little bit nervous more than being proactive.
The volumes are already crazy.
The volumes are through the roof, right? So they're very much aware of that, and they don't want to be letting clients down, and understanding in the current market, they have been already prioritizing contracts over refinancing, over pre-approvals. That will be very strict in the run home to Christmas. So again, if you're also looking at the idea and you're starting to do refinances, or if you're doing a purchase that includes a refinance or equity from a property, understand the flow and effect that this is all going to have. So we will talk about this a lot over the next few weeks, and it might sound a little bit repetitive, but can't really say we didn't tell you. It's just really important. So we're talking a lot with this clients at the moment. 1st of November, some exciting. I gave you good news. I'll let you give that good news.
Okay. So the APRA changes, which we've talked about a few times, come into effect on Monday. So we'll be getting all the new calculators through. So that's where the minimum assessment buffer rate the bank uses to determine your borrowing capacity will increase from 2.5% above the actual rate to 3%. Okay, so we are waiting for those calculators to come out, and then we'll actually get some clarity around what difference is this going to make. It's going to be different for all of the banks.
Yeah, and so if you did a borrowing capacity 6 months ago, it's potentially going to be different come Monday, in simple terms. So lucky us, lucky our team, get to pull these apart and pull them back together again. The excitement builds, but we're already seeing in some of the initial numbers that will have an impact for some that were potentially tight previously. Others maybe not so, because some were quite relaxed around that figure as it was, and some were way over already. So watch this space. You heard it first as well here a few weeks ago. Fixed rates on the move. We called it first. Not really, but we did speak about it, and fixed rates are and have moved. We've probably seen 8 or 9 banks in maybe the last 6 or 7 days start to increase their, and it's different. There's a sweet spot for each bank, and some have put 2 years up, some have put 3 years, some have only done owner occupied, some have only touched investment. It's very difficult to keep up with, but we spoke a lot about rate lock, locking in those. We've got a lot of clients, and you talk to people and they go, we're going to hold off because what if rates went down? If you're in that batch and you've been thinking about it, now might be a good time to explore that, because we're seeing anything from sort of 0.15% up to 35 basis points. 0.15 to 0.35 is a bit of a mixture. Some have gone from a 2.1 up to a 2.4. Some have really jumped, and others have gone maybe, or even 10 basis points. So from 1.99 to 2.09. So it's just, how does this affect you, and potentially the lender and options you're looking at? It's going to be really important. So definitely reach out, touch base with us, of course, and we'll do the rest. I'll get switched to you for the other bit of bad news.
Give me a bit of screen time. All the bad news stuff.
Correct.
Cool. So another update is around what we love a good acronym and what we do. So CCR, or Comprehensive Credit Reporting. So that's around your credit files. We've talked about before how previously they would just show the big stuff, defaults, arrears, inquiries, bankruptcy, that. Now your credit file is obviously much more detailed. It shows the conduct on your liabilities or your credit facilities. The next move in that, which is November, is that now the buy now, pay later facilities, which currently aren't all the time, terrible. Tracked on those will now show on CCR as well. Okay, so that's your what were we doing? There's buy now, pay later, afterpay,
step pays, pay it laters.
Everyone's got a version of it. So just understanding those will be on there, and also your telcos. So Optus have said yes, they will be starting to use CCR, and we expect the others will follow.
And understand 2 years worth of conduct. Is now reported on that facility, and the reporting starts at 0 to 30 days late, which is a 1, and then a 30 to 60 days late, which is a 2, and so forth. So when you may have just, again, a buy now, pay later, which wasn't a huge thing, and I missed a payment, I forgot, or the bloody phone bill I meant to pay, it didn't come out on the day, and they've marked that as late, where previously it's like, well, it's not really an issue. You see a little bit of a red on the statement, you go, that's not a problem, I just got to pay it. Or now understanding the flow-on effect they are going to have. This is big. It's probably, well, comprehensive credit reporting has probably had already crept in, and for credit cards and stuff, but people were more aware, I think, of some of those facilities, and probably a little bit more conscious because they were getting $10 and $15 fees, where this stuff, which is unfortunately becoming a big trend, we're just sort of a little bit worried about what that might look like. So if you do have those, whilst it is convenient, they are easy to use, highly recommending understanding they are looked very unfavourably upon, it's the nicest words I could come up with, from the banks in any case. But now when they start reporting the data on these, even when you do close it, it's still going to show for those 2 years, right? So the quicker you can get rid of them, the quicker. And if you've got friends, kids, family, anyone uses this stuff, get rid of it. I don't have shares clearly enough to pay. But we just know the flow-on effect it now has to lending, which is really frustrating because it's just a payment type, right? It shouldn't be this complicated.
And it's just a big focus around confirming you can meet your current commitments. So things like late payments or I forgot to make it doesn't support your ability to get extra lending or extra funding. Okay, so that's a big part of it. So the banks are using that now. They can see everything. We can't, before a bank would only see maybe what they had, but now everyone sees everything. So just do be conscious of it. If you have these type of facilities, either as Phil said, get rid of them, or if you want to keep them open, make sure they're paid on time.
And send this video to them and say, I told you so, and they can listen and get to this bit. Yes, I'm talking to you. You lost the bet.
Thanks, Dad.
Yeah. So that's our super advice for that. But it's coming. So watch this space and be mindful of what that will do to your credit score and credit file. But that's us for a big week. It's been. We look forward to chatting next week. As always, you need anything, reach out and get in touch. We're happy to help.
Cool. Have a great weekend.
Okay. Bye.
Bye.